Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, this will be the last show for a couple of weeks because we've got Easter coming up. So it means we've got a couple of shortened trading weeks. So less will be going on, but we will be back in the next few weeks with more on Damien's Midweek Markets. But what's been going on this week in equity markets is something that's probably going to be talked about for years to come. Now, by the end of last week, it looked potentially like technology stocks, which have been battered, to be honest, as part of the reflation trade, might be catching a bid, and we might finally get a bit of stability from which they could potentially rebound from. But then with technology stocks, it doesn't rain, but it pours at the moment, and things took a turn for the worse. The first inkling we got was a really aggressive sell-off in Chinese technology stocks. And then we saw a similar pattern in US technology stocks at the back end of last week. And the giveaway that something was going on was the aggressiveness of the selling, but also the batch nature of it. So there were huge chunks, $1 billion worth of shares in particular companies that were being dumped upon the market. And speculation abounded about what was going on. Has a hedge fund, for example, imploded? And in the days that followed, we actually found out that that is exactly what had happened. And there was a hedge fund by the name of Archegos Capital that was using derivatives to make huge bets on particular stocks. And it meant that they were using leverage provided by investment banks to have these bets. And where we've had a bit of weakness in particular stocks of late, and technology stocks in particular, it meant that the investment banks out there, and we're talking about names that you will have heard of, like Credit Suisse, for example, JP Morgan, were having to call for more collateral from this particular hedge fund in order to keep these bets open. And in the end, they weren't able to provide that. So it meant that the investment banks had to start unraveling these huge bets. There's lots of questions now being asked about how this situation arose, given the history, which I won't go into, of this particular hedge fund and the person who was at the head of that. But the bets had to be unwound, and it meant that $20 billion worth of stock, in particular technology giants, like I say, in America and in China, were being dumped on the market en masse. And it was almost a race by these investment banks to do so. And it caused these stocks in particular to plummet in value. So we saw another leg lower in technology stocks. So if you've been holding technology stocks last week, you'd been perhaps wondering what was going on, because things looked like they could be stabilizing after the sell-off that we saw from February into March. But the net result is that these investment banks have themselves now become exposed to heavy losses as a result of the leverage and the derivatives that were behind these huge bets on technology stocks in particular. And to give an example, Credit Suisse came out and said that their own losses are likely to run into billions and billions of dollars worth. And actually their share price fell 14% on Monday alone. Now, that gives you a hint of the potential impact on markets. The question was, it still remains to be honest, is there some kind of systemic risk now in investment markets? Could we see another Lehman's style moment that we then see markets eventually unravel? At the moment, the market is looking beyond this particular incident, because we've seen a bit of stability in some of those bank stocks after initial aggressive sell-off on Monday. One concern has been that obviously financials have been leading the market higher of late as part of this reflation trade. And if they then show weakness, could it mean the whole stack of dominoes come collapsing down if financials start to turn down lower? At the moment, we've seen a bit of stability after those initial losses. So we're going to have to wait and see whether there is a systemic problem, although the market is moving on, suggesting that there isn't. But the loss on this hedge fund is being put down as the single greatest loss of personal wealth in history by the person who runs it. So you just puts the scale of this problem into context. And so that has been something that is on the market's mind. You add that to the other worries that are out there. COVID-19 is rearing its head again. We're having problems with vaccine rollouts in Europe, rising case numbers. I mean, there are still reasons to be slightly apprehensive about markets, but if you look at investment markets, we're still seeing markets pushing to multi-year highs on the DAX, all-time highs on the Dow Jones. It's really technology stocks and the growth stocks that are lagging. They're not necessarily sitting on huge losses when you look year to date. In fact, if we run through the year to date returns for a UK investor, then the Nasdaq 100 is largely flat for the year despite the sell-off. So we had a huge rally into February and then it's pulled back. We've seen a similar thing for Japanese equities if you're a UK investor. But if you look at the other indices, the Dow Jones is up about 9.5%. The FTSE is up about 5.8% year to date. The S&P 500 is up about 5.3%. This is all converted back into sterling terms. The DAX is up 3%. On its own price basis, it's actually up even higher. It's one of the leading stock markets year to date. But when, like I say, you convert it and take into account currency moves, it's up around 3%. Even Asian and emerging market equities are up around 2 to 3% year to date. And that is after they are up about double digits, sort of about 12% by the mid-February period. So you can see that although we've had some pullback, it has come from a high base. So at the moment, despite the sell-off, despite the worries that are out there, the world hasn't ended. What we've had is, with the reflation trade, a nuance to what's been going on. So it'll be interesting to see what happens as we go into the next quarter. And this quarter has been particularly tough for government bonds. It's in fact one of the worst quarters the worst quarter for 20 odd years for anybody holding UK gilts. And we saw the US Treasury yield rise by from 0.9% at the start of the year to around about 1.75% as I make this. So the reflation trade at the moment is still on. And we are awaiting today more information about Joe Biden's potential stimulus plans in the US. So there could be more information on that, which could cause some friction or sort of wobbles in the bond market, because obviously, depending on how he's planning to fund that or the scale of that, that is likely to have an impact on yields in the next few days. So do keep an eye on that. So as we move into the next quarter, it'll be interesting to still keep an eye on the bond yield, so the 10-year US Treasury yield, the 10-year UK gilt yield. Keep an eye on what's going on with the key indices, the Dow Jones, the DAX. Those are real beneficiaries of the reflation trade. Keep an eye on what's going on with things like the Nasdaq 100, which is full of technology stocks, which has been a laggard in the reflation trade. But also keep an eye on things like the VIX, which is obviously the thing that they call the market fear index. That's a good steer to see what investors are thinking. And at the moment, it's still down at around the multi-year average. So there isn't extraordinary fear out there in the markets. In fact, if you look at the CNN Market Fear and Greed Index, which gives you a broad measure taking into lots of factors what emotion is driving the market. Is it, on the one hand, fear, or is it greed? At the moment, it's largely in the middle, probably erring slightly, ever so slightly, on the side of fear. So we're not at the euphoria stage as yet. So there's plenty going on in the next couple of days and weeks to look out for. And when we're back, as I say, in a couple of weeks' time, it'll be interesting to see where markets have gone to and whether the reflation trade is continuing. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me on email, damien@moneytothemasses.com, Twitter, Money to the Masses with the number 2. You can find me on Instagram and, of course, on Facebook. So that's the group in particular. That's facebook.com/groups/money to the masses. And don't forget to subscribe to our YouTube channel.